This deep dive is brought to you by CertFuel. They've got a full Securities Industry Essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted just like the real thing. Check it out at certfuel.com.
Yeah, it's honestly the best way to train your brain for the actual format of the exam. Highly recommend it.
Seriously, so imagine losing $10,000, not because you picked the wrong stock, and not because the market crashed.
Right.
But simply because you ignored, like, a single boring-looking piece of mail from your brokerage firm.
Which happens way more often than you'd think.
Oh, I bet. Today, we are opening up the floorboards and looking at the hidden plumbing of the stock market. You're studying for the Securities Industry Essentials exam, the SIE.
The big one.
Right, and you're looking at the syllabus, and staring back at you is this massive, just totally intimidating chunk called trade settlement and corporate actions.
Which, I mean, usually elicits a massive groan from test takers.
Yeah, exactly.
It sounds like reading the terms of service on a software update. You know, people think it's just endless paperwork and arbitrary deadlines.
But here's why you need to care. And I mean really care. This topic. It makes up 31% of your entire exam.
That is massive.
We're talking roughly 23 questions. You cannot pass the SIE without knowing this stuff cold.
And if you just try to rote memorize 23 discrete facts, the exam writers will absolutely destroy you.
Oh, they love doing that.
They do. They are incredibly skilled at writing scenarios that look like one thing but are actually another. We really had to learn the actual mechanics of the market.
Like, how do the gears actually turn, right?
Exactly. When you understand the why, the what becomes obvious. And you don't have to rely on raw memorization.
So to keep us grounded and to give your brain something sticky to hold on to, we're going to follow a cast of characters today.
I love this. The market isn't just numbers on a screen. It's people doing wildly unpredictable things.
Exactly. So meet our 3 VIPs for today's deep dive. First, we have Frank, the founder.
Okay, Frank.
Frank is the highly eccentric CEO of a volatile, completely ridiculous, publicly traded company called Frank's Futuristic Flamingos.
Visionary, clearly. But maybe not the most stable underlying business model.
Precisely. Then we have Sloan the Shareholder.
Sloan.
Sloan is an impulsive retail investor. She loves the thrill of hitting the buy button on her app, but she completely ignores her physical mail.
The worst.
She deletes her emails without reading them, and she consistently misses critical deadlines.
The nightmare client. I mean, we all know a Sloan.
We definitely do. And finally, caught right in the middle of this mess, we have Broker Bob.
Poor Bob.
Bob is the stressed out middleman. He's Sloan's broker, and he basically spends his entire professional life just sweating.
Just trying to follow FINRA rules.
Exactly. Desperately trying to make sure he doesn't get fined because of Frank's crazy corporate moves or, Sloan's utter lack of attention.
Broker Bob is the true unsung hero of the financial system.
Yeah.
He's the guy holding the chaotic machinery together.
He really is. So let's start at the absolute beginning of a transaction, because you can't understand how Frank's corporate actions affect Sloan's shares until you understand when Sloan actually legally owns those shares.
Right. The timeline is everything.
So I'm going to ask you, the listener, a direct question right now. Think about this. If Sloan logs into her brokerage app and buys 100 shares of Frank's Flamingos on a random Friday at noon, does she own them that instant? Got your answer? Nope. She doesn't. The trade date is just the handshake. It's the agreement.
Right.
The settlement date is when the keys to the car and the actual check change hands.
And that distinction is the bedrock of the entire securities industry.
Yeah.
The trade date, which we abbreviate as T, is simply the moment the order is executed on the exchange.
Okay.
But between the trade date and the settlement date, the transaction is nearly pending. Neither party has fully delivered yet.
So it's floating in limbo.
Exactly. Sloan hasn't officially handed over the cash from her bank, and the seller hasn't officially transferred the legal ownership of the shares. That legal transfer of ownership only happens on the settlement date.
Okay, so what is that exact timeline? Because I know the SEC just overhauled this recently, and it's guaranteed to be a massive focal point on the exam.
Oh, it's arguably the biggest mechanical change in the markets in a decade. Effective May 28th, 2024, the SEC adopted amendments that changed the standard settlement cycle.
Right.
We moved from T+2, which was trade date plus 2 business days, to T+1.
Trade date plus 1 business day.
Exactly.
Wait, let me push back on that for a second. Why did the SEC force the entire financial industry to speed this up? Because, upgrading all those legacy computer systems, the clearinghouses, the algorithm,
Well, it was a massive undertaking.
that had to cost Wall Street billions of dollars in tech upgrades. Doesn't speeding up the timeline actually increase the risk of a broker making a typo? Or, like, a computer system crashing because they have literally half the time to fix a mistake?
Well, that's a very logical assumption. And it was actually the primary argument against moving to T+1.
Really?
Yeah, the fear of operational failure.
Yeah.
But the SEC determined that the counterparty risk of a longer settlement period was infinitely more dangerous than the operational risk of a shorter one.
Okay, walk me through that. Counterparty risk. What does that actually mean in plain English?
Let's use our characters.
Yeah.
Let's say Sloan is buying those 100 shares of Frank's Flamingos from a guy named Dave.
Okay, Dave the seller.
They shake hands digitally on Friday. The price is locked in. If settlement takes 3 or 4 days, like it used to, what happens if Dave goes completely bankrupt over the weekend?
Oh, wow.
Or what if there's a massive, unprecedented market crash on Monday morning? Suddenly, Sloan's portfolio is wiped out, and she no longer has the cash to pay for the shares she agreed to buy at Friday's higher price.
Ah, I see. So time equals exposure.
Exactly. Time is risk.
The longer the trade is hovering in limbo, the higher the chance someone defaults on the deal.
Exactly. Less time between trade and settlement equals less exposure to wild price movements, less counterparty risk, and less credit risk.
That makes total sense.
Remember the whole meme stock frenzy a few years ago?
Oh, how could anyone forget?
Right. A lot of the trading halts on certain brokerage apps happened precisely because of T+2 settlement.
Wait, really? It wasn't just a conspiracy to stop retail traders.
No. The brokers had to post massive amounts of collateral to the clearinghouse to cover 2 full days of incredibly volatile pending trades.
Oh, wow. So they literally ran out of collateral money.
Exactly. By shrinking that window to T+1, the SEC is basically making sure nobody has time to go broke before they pay their tab. It frees up billions in capital that used to be locked up as collateral.
That is fascinating when you put it that way. So T+1 is the new reality. If Sloan shakes hands on Friday, when do the keys actually change hands?
Yeah.
Let's talk about how we count the days.
So the golden rule here is that we only count business days. Weekends and official exchange holidays are completely invisible to the settlement calendar.
Invisible. Got it.
So if Sloan executes the trade on Friday, Saturday, and Sunday do not exist in the eyes of the SEC. Settlement happens on Monday. That is T+1.
Let me throw a curveball at you. What if she trades on a Monday, but Tuesday happens to be the 4th of July?
Well, Tuesday is an exchange holiday, so it's a ghost day. It doesn't count.
Okay.
Settlement would simply skip to Wednesday.
Okay, now what specific securities does this T+1 rule apply to? Because the exam loves to give you like a multiple choice list of different obscure assets and ask which ones apply.
It applies to the vast majority of what you'll see on the exam.
Okay.
Equities, so standard stocks like Frank's Flamingos.
All right.
It applies to corporate bonds. It applies to municipal bonds. It applies to options. And it applies to U.S. government securities like treasury bonds.
Hold on, I want to clarify something there. I was reading through the source material and I thought I saw a technicality that U.S. government securities were actually exempt from the strict SEC rule. Am I misremembering that?
No, you're actually spotting a very deep nuance there.
Oh, really?
Yeah. Technically, under the strict letter of SEC Rule 15C6-1, U.S. government and municipal securities are exempt from the SEC's specific mandate.
Okay, so I wasn't crazy.
You aren't.
Right.
However, you don't trade in a vacuum. By standard market convention and through rules established by the MSRB, the Municipal Securities Rulemaking Board, they still settle on a T+1 basis.
Ah, so it's a distinction without a practical difference for the trader.
Exactly. So for exam purposes, if they ask for the regular way settlement of a treasury bond or municipal bond, the practical testable answer is T+1.
Got it. Okay, listeners, pay very close attention right now, because here is an exam trap call-out. I am explicitly warning you about how the test makers are going to try and weaponize the vocabulary against you.
They are so sneaky with this one.
The exam will try to trick you by confusing the phrase regular way with cash settlement.
It is one of their absolute favorite traps.
Yeah.
Because the words sound like they should mean the same thing to a layperson.
Right. If I go to a store and pay cash, I get the item immediately. So regular way settlement is the default. It's the automatic standard for the entire market. And as we just established, regular way is T+1.
Right.
But the exam might present a hypothetical scenario like Sloan wants to buy shares and requests cash settlement. when does the trade settle? And they will confidently offer you choices like T+1, 2+2, or same day.
Right. And cash settlement means same-day settlement,
Yeah.
T+0. The trade executes and legally settles before the end of that exact same business day.
But, and this is the core of the trap, folks, cash settlement is never the default. You cannot just log into your consumer brokerage app, check a box that says cash, and get same-day settlement.
No, absolutely not.
It requires a highly specific, customized, bespoke agreement between the buyer and the seller before the trade even takes place.
Precisely. It's usually reserved for institutional players who need to meet a very specific, urgent deadline. And they're willing to pay a premium for the logistical hassle of settling outside the standard automated batch process.
So if an exam question asks about the default or the standard or uses the phrase regular way, the answer is unequivocally T+1.
Yes. Do not choose same-day settlement unless the prompt specifically uses the exact words cash settlement or explicitly outlines that a special prior agreement was negotiated.
Okay, so Sloan buys her Flamingo shares on Friday, regular way settlement. By Monday, T+1, the money has left her account and she legally owns those shares.
Right.
But what exactly does she own? Because I know she isn't getting like a wax-sealed parchment paper delivered to her mailbox.
No, definitely not.
Which brings us to the concept of how securities are actually held.
Right. Because we are settling millions of trades every single day, we obviously aren't mailing physical paper certificates back and forth across the country.
That would be a nightmare.
It would be physically impossible to achieve T+1 settlement if we relied on couriers and the Postal Service.
Oh.
Wall Street actually tried that in the late 1960s, and it almost collapsed the entire financial system.
Wait, really?
Yeah. Brokerages were literally drowning in undelivered paper certificates. They had to close the markets on Wednesdays just to catch up on paperwork.
Oh my gosh. I can't even imagine Broker Bob trying to lick 100,000 envelopes every Monday.
He'd quit.
So to solve that paper crisis, the industry created a standard for holding securities, which is called street name or book entry.
Yes.
I've always found this term hilarious because street name sounds a little shady, like you're buying stocks out of the trunk of a car on Wall Street.
It does sound a bit illicit.
But it's actually the most regulated, efficient system on Earth.
It is the absolute standard method for holding securities today. And to truly grasp how it works, we need to separate the concept of ownership into two distinct legal categories.
Okay, what are they?
You have the registered owner, which is sometimes referred to as the nominee, and the beneficial owner.
Okay, let's use an analogy here to make this concrete, not the cliche pizza analogy. Let's talk about cars.
Okay, I like cars.
Let's say you go to a dealership and you finance a beautiful new car. You drive it off the lot. Who drives the car every day? You do. Who pays for the gas? You do. Who gets a speeding ticket if you run a red light? You do.
Unfortunately.
And if you sell it for a profit, who keeps the money? You do. But if you look at the actual legal public title of that car sitting in the DMV's database, whose name is on it?
The bank's name, or the dealership's financing company.
Exactly. The bank is the registered owner on paper. They hold the title. But you are the beneficial owner. You get all the economic benefits of the car and you take all the economic risks of the car. Street name works exactly the same way in the stock market.
That's a perfect analogy. So bring it back to our characters. When Sloan buys her 100 shares of Frank's Flamingos, those shares are held in street name.
Okay.
That means Broker Bob's firm, the broker-dealer, is the registered owner. It is Broker Bob's corporate name that actually appears on Frank's official corporate ledger. But Sloan is the true beneficial owner.
So another exam trap, call out right here. The exam will try to present a scenario where they imply that because the shares are held in the broker's name, the customer somehow loses a fraction of their rights.
False.
Exactly. False. Sloan keeps 0% of her name on Frank's books, but she retains 100% of her economic rights. She gets every penny of the dividends, she retains all the voting rights, and if Frank's company goes bankrupt and the stock goes to zero, Sloan takes the total financial hit. Broker Bob loses nothing.
Right. Street name is purely an administrative logistical mechanism. It allows the broker-dealer, or on a macro level, a massive central depository like the DTCC, to simply update digital ledgers instantly to settle trades.
Wait, let's pause right there. You just dropped an acronym. DTCC, the Depository Trust and Clearing Corporation.
Yes.
I want to explain this because I think it's one of the most fascinating pieces of hidden trivia in the financial world. And it helps explain the why of all of this.
It really does.
If you trace the ownership of almost every single publicly traded stock in America all the way to the very top, to the ultimate registered owner whose name is on the physical master certificates locked in a vault in New York.
Seed and Company. It's the nominee name for the DTCC.
Seed and Company, a partnership that technically owns trillions of dollars of American wealth.
It's wild to think about.
But they are just the master record keeper. When Sloan buys from Dave, Seed and Company doesn't move any paper. They just update a spreadsheet that says, move 100 shares from Dave's broker to Sloan's broker.
Exactly.
And then broker Bob updates his internal spreadsheet that says, allocate 100 shares to Sloan's account. It is a beautiful illusion of ownership that makes T+1 mathematically possible.
The friction is entirely removed. That's the key.
Okay, but let's say Sloan is deeply paranoid. She reads some conspiracy theory online and decides she doesn't trust broker Bob. And she certainly doesn't trust Seed and Company.
Naturally.
She says, no, I want my actual name, Sloan, directly on Frank's corporate books. I want to be the registered owner. But she also knows that physical paper certificates are a logistical nightmare. Is there a middle ground for her?
Yes, there is. That middle ground is called the Direct Registration System, commonly abbreviated as DRS.
DRS, break down the mechanics of that for us.
So DRS is still entirely an electronic book entry system. There's no physical paper certificate being mailed around.
Okay, that's good.
However, unlike street name, the shares are registered directly in the individual investor's name, Sloan's name, on the issuing company's official books. This ledger is maintained by a specialized entity called a transfer agent.
What exactly is a transfer agent? Because that's another term that gets thrown around a lot on the test.
A transfer agent is a third-party financial institution, often a trust company or a bank, hired by Frank's Flamingos to maintain the master list of exactly who owns their stock and how many shares they hold.
Got it.
They cancel old shares, issue new ones, and handle the distribution of dividends.
So in the DRS system, Frank the founder looks at his master corporate ledger managed by his transfer agent, and instead of seeing an entry that says broker Bob's firm holding 100,000 shares, he actually sees a specific line item that says Sloan holding 100 shares.
Exactly. And in DRS, Sloan doesn't get a standard monthly brokerage statement from Bob for those specific shares. Instead, she receives a periodic statement of direct ownership mailed to her directly from Frank's transfer agent.
Why would a normal retail investor go through the hassle of doing that?
Well, some investors strongly prefer the psychological security of knowing their name is directly on the company's ledger. It fully insulates them from any potential bankruptcy of their broker-dealer.
Okay, that makes sense.
But there is a massive operational downside, and this is what the exam cares about: liquidity friction.
What do you mean by friction? Like, it's harder to sell.
Exactly. If Sloan holds her shares in DRS and suddenly sees Frank's stock cratering and she wants to panic sell immediately, she usually can't just click sell on an app.
Oh, really?
Yeah, she typically has to instruct the transfer agent to electronically move the shares back over to broker Bob's firm, re-registering them into street name, before broker Bob can legally route the sell order to the exchange.
Oh, wow, that sounds slow.
That extra administrative step takes time. And in a crashing market, time is money.
Ah, so you trade speed and liquidity for direct registry. Got it. Okay, and finally, let's talk about the dinosaurs of the financial world. Physical certificates.
Very rare these days, heavily discouraged by brokers, but still highly testable.
So if Sloan is incredibly old school and insists on having actual physical paper shares of Frank's Flamingos delivered to her safe at home, what are the rules?
First, you need to know this is the absolute slowest, most expensive method of settlement. Because to transfer ownership, that physical piece of paper literally has to be removed from her safe, transported, verified for authenticity, canceled by the transfer agent.
Oh my gosh.
And a brand new certificate has to be printed and issued to the buyer.
And the exam loves testing this specific phrase, good deliverable form. What constitutes good deliverable form?
If Sloan holds a physical certificate and wants to sell it, that piece of paper must be in pristine, legally recognized condition. That means it must be properly endorsed.
Endorsed meaning signed.
Yes, signed by Sloan on the back. And the signature must exactly match the name as it appears on the front of the certificate.
Okay.
So if this says Sloan A Shareholder on the front, she cannot sign it just Sloan Shareholder. It must also be accompanied by a medallion signature guarantee, which is a special bank stamp proving she is who she says she is.
That sounds like a hassle.
It is. It must be in the correct denomination. And crucially, it cannot be defaced in any way.
So no coffee stains.
No coffee stains, no dog ears that obscure the serial number, no water damage, and no toddler drawing on the back with a crayon.
Right.
If the certificate is damaged or illegible in the slightest, the transfer agent will reject it, the broker will refuse to accept it, and the trade will fail to settle.
Okay, let's pause and reset the narrative for a second here. We know trades settle T+1 to reduce counterparty risk. We know almost all of those trades are held efficiently in street name, meaning Broker Bob's corporate name is on Frank's master books, but Sloan is the real beneficial owner.
Correct.
But wait, if Frank the founder wants to send a letter to his shareholders, he doesn't even know Sloan exists. He just sees Bob. How does the mail ever get to Sloan?
This is exactly where the friction of the street name system rears its head, and it creates a massive compliance headache for our friend Broker Bob.
Right, because Frank is sitting in his CEO suite, and he decides it's time for the annual shareholder meeting. He is legally required to mail out the annual reports, the audited financial statements, and the voting ballots. So Frank mails 100,000 bulky annual reports directly to Broker Bob's firm. What happens now?
This triggers Federal Rule 2251.
Yeah.
Broker Bob has a strict, heavily audited legal obligation. He cannot just throw those reports in the recycling bin because they take up too much space.
Though I'm sure he wants to.
Oh, absolutely. But he is required to promptly forward all issuer-related materials directly to the beneficial owners, meaning to Sloan.
The operative testable word there is promptly. The exam might try to trick you with multiple choice options, like Broker Bob must forward materials upon customer requests, or he must forward to them at the end of the quarter.
Yeah.
He is an involuntary, legally bound mailman. He must promptly forward everything. Dividend notices, annual reports, tender offers, all of it.
Exactly. Because if he delays, Sloan is being actively denied her fundamental rights as an owner of the company to review the financials and cast her vote.
Okay, so Bob frantically overnight mails the annual meeting packet to Sloan's house. Inside that packet is a voting ballot, legally known as a proxy. What exactly is a proxy?
A proxy is simply a written legal authorization. It's Sloan giving a designated representative the legal power to cast her specific vote at the shareholder meeting.
Okay.
Because realistically, Sloan is not going to buy a plane ticket, fly to the corporate headquarters of Frank's futuristic flamingos, and raise her hand in a crowded boardroom.
Right. It's essentially a corporate absentee ballot. Now, exam trap Cal out. Listeners, grab a pen and write this down. The exam loves testing the specific federal rule numbers in this area.
They really do.
The rules governing proxy solicitation are found under Section 14A of the Securities Exchange Act of 1934.
Yes. The test writers will try to confuse you with other famous sections. They'll throw in Section 12 or Section 16 as distractors.
How do you tell them apart?
Well, Section 12 deals with registering securities. Section 16 deals with the reporting requirements of corporate insiders. Section 14A is always the proxy rule.
14A all the way. Okay, so Sloan gets this proxy absentee ballot in the mail from Broker Bob. It has a list of things Frank wants to do at the company, and she needs to vote yes or no. But let's remember our character profile of Sloan. She notoriously ignores her mail. She throws the envelope on the kitchen counter, unopened, and goes out for coffee.
Classic Sloan.
Weeks pass. The deadline approaches. Broker Bob is sitting at his desk, sweating profusely. He holds Sloan's unvoted shares in his street name account. He needs those votes submitted. Can Broker Bob just fill out the ballot and vote on her behalf so the shares don't go to waste?
This specific scenario brings us to one of the most heavily tested critical concepts on the entire SIE exam. The legal distinction between routine and non-routine matters.
Okay, listeners, pattern interrupt. Stop whatever you are doing right now. If you are washing dishes, put the sponge down. If you are walking the dog, stop walking. Focus completely on this.
This is huge.
If you remember absolutely nothing else from this entire deep dive, make it this next distinction. It is mathematically guaranteed to be on your test.
The fundamental rule is this. If Sloan ignores her mail and gives no voting instructions, Broker Bob may use his own discretion to vote her shares on routine matters.
Okay, routine matters.
However, he is strictly forbidden and may not vote her shares on non-routine matters.
So we need to know exactly what counts as routine versus non-routine. Let's start with a direct question to the listener.
Okay.
Frank's Flamingos wants to execute a massive merger with a giant pelican company. It will fundamentally change the business. Sloan didn't reply to her mail. Can Broker Bob look at the ballot and vote yes on the merger for her?
Think about that for a second.
No, absolutely not. A merger is a massive, fundamental, structural change to the company. That is the definition of highly non-routine.
Exactly. Broker Bob has no right to make that economic decision for her. If we look at the official list of non-routine items, it includes mergers and acquisitions.
Yeah.
It includes executive compensation, which you might see on the exam referred to as say on pay.
Say on pay. Got it.
It includes authorizing new stock option plans for management. And crucially, heavily tested, it includes the election of directors.
Wait, hold on. Electing the board of directors is considered non-routine. Haven't brokers historically just rubber stamped to the incumbent board for decades to keep things moving?
They absolutely used to. And that's exactly why it's a trap today. Prior to 2010, brokers were allowed to vote on uncontested director elections at their own discretion.
Oh, really? So what changed?
Well, you have to look at the historical context. Following the 2008 financial crisis, there was a massive public backlash against corporate boards and CEOs who were seen as unaccountable.
Ah, right.
The Dodd-Frank Wall Street Reform Act fundamentally changed the landscape of shareholder rights. The SEC and the exchanges changed the rules. Electing the people who actually run the company is now considered a critically non-routine matter.
That makes total sense.
The era of the broker rubber stamp is over. Broker Bob cannot vote for directors unless Sloan explicitly tells him to.
That context makes it so much easier to remember. They took the power away from the brokers to give it back to the shareholders. So if almost everything important, mergers, pay, directors, is non-routine, what on earth is actually left that qualifies as routine?
For the purposes of the SIE exam, there is essentially only one major routine matter you will ever be tested on: the ratification of auditors.
The auditors. Okay, here is your mnemonic memory aid, folks. The letter R, routine equals ratification of auditors.
Perfect.
If the question asks what a broker can vote on using their own discretion without client instruction, look for the R ratification. If it's directors, mergers, compensation, or stock plans, non-routine. Hands off, Bob.
It's a flawless memory trick. Routine equals ratification.
Okay, let's play this out mechanically.
So.
The day of the shareholder meeting arrives. The agenda has 2 items on the ballot. Item 1 is ratifying the independent auditors, and item 2 is the merger with the Pelican Company.
Okay.
Sloan has totally ghosted Bob. So Bob submits the proxy. He votes yes on the auditors, because that's routine, but he legally cannot vote on the merger. What happens to Sloan's 100 shares for that merger vote? Do they just vanish into the ether?
They don't vanish. They become a specific accounting classification known as a broker non-vote.
A broker non-vote. Walk us through the math of how that impacts the meeting.
When Bob is forced to leave the merger question blank because Sloan gave no instructions, he submits the ballot with a broker non-vote for that specific item. Here is the exam trap call-out. Broker non-votes are counted toward establishing quorum, so they do not count as actual votes for or against the specific proposal.
Define quorum for us in this context.
Quorum is the legal minimum number of shares that must be represented at the meeting, either in person or by proxy, for the meeting to be considered legally valid and official.
Okay.
Let's say Frank's corporate charter dictates he needs 50% of all outstanding shares present to even hold the meeting. Bob submitting that broker non-vote basically signals to the corporate secretary, hey, Sloan's 100 shares are in the room. We are present. Count our bodies for attendance.
So those 100 shares help meet the 50% quorum requirement.
Yes.
They show up to roll call, but they refuse to speak.
Precisely. They do not count as a yes, and they do not count as a no. In effect, they act exactly like abstentions. And this is really important for understanding the why of corporate power dynamics. Because they don't count as yes votes. If a company needs an absolute majority of all outstanding shares to approve a massive merger, having a ton of broker non-votes makes it mathematically much harder for management to pass big changes.
Because the denominator, the total number of shares required, stays big, but the numerator, the actual yes votes, isn't growing.
Exactly.
That is fascinating. The sheer laziness of retail investors like Sloan literally acts as a mathematical brake on corporate management trying to push through radical changes.
It really does, which is precisely why companies will spend millions of dollars hiring proxy solicitation firms.
Oh, is that why I get those annoying phone calls?
Yes. These firms will literally call retail investors at their homes during dinner time, begging them to open their mail and send in their...
So to recap Bob's miserable existence, he has to promptly forward the giant stacks of mail. If Sloan ignores it, he is legally paralyzed. He can only vote on the R ratification of auditors. Everything else results in a broker non-vote, which is just attendance, not an opinion.
You've got it perfectly.
All right, let's pivot and move into the math portion of the exam. We are talking about mandatory corporate actions.
The math section.
These are fundamental changes Frank makes to his company's stock structure, where Sloan doesn't even get the luxury of a vote. She's just along for the ride. And the biggest, most heavily tested one in this category is the stock split.
Yes. Stock splits and reverse stock splits. If you encounter a pure math question on your exam regarding corporate actions, it's highly likely to be calculating a split.
So let's set the narrative scene. Frank's futuristic flamingos has been doing incredibly well. Sales are through the roof. The stock price has soared to $80 a share.
Good for Frank.
Right. But Frank is worried. He is looking at consumer psychology, and he thinks an $80 price tag is too expensive, or too intimidating for regular retail investors to buy. He wants the stock to be trading around $40 so more people feel comfortable buying full shares. So Frank executes a mandatory 2-for-1 forward stock split.
Okay, let's use an analogy to explain the mechanics of this, because it often confuses new investors who think they're suddenly getting free money.
Oh, totally. Let's avoid the cliche pizza analogy. Everyone uses the pizza. Let's talk about tipping a valet.
Tipping a valet.
Let's say you have a single crisp $100 bill in your wallet. You pull up to a fancy hotel, and you need to tip the valet for parking your car. You obviously can't hand him a $100 bill, and he can't make change. The $100 bill is too expensive to use efficiently.
Right.
So you walk into the hotel lobby, go to the front desk, and ask them to break your $100 bill into 5 $20 bills.
That's a great way to visualize it.
So the desk clerk hands you 5 20s. I ask you, did you just get richer? Did the hotel give you free money? No. You walked in with $100 of purchasing power, and you walked out with $100 of purchasing power.
So you just changed the denomination.
Exactly. You increased your liquidity, making it easier to transact. A forward stock split is the exact same thing.
That is the crucial takeaway here. Exam trap call-out. A stock split does not create fundamental economic value. It does not magically increase your portfolio balance. It does not generate yield or income. And crucially for the IRS, it is not a taxable event.
Never a taxable event.
The exam will give you a convoluted scenario about a split and ask what happens to the investor's total overall value.
Yeah.
The answer is always, it stays exactly the same.
Let's walk through the actual math on that 2-for-1 forward split using Sloan's brokerage account. I want to do this painfully slowly so everyone can follow the logic.
Let's do it. Before Frank announces the split, we know Sloan owns exactly 100 shares. The current market price is $80 per share. So 100 shares multiplied by $80 gives her a total investment value, or total cost basis, of $8,000.
Okay, 100 shares, $80, $8,000 total pie.
Now, the 2-for-1 split goes into effect. To find her new share count, the formula is simple. Multiply her current shares by the first number of the split ratio and divide by the second.
So 100 shares times 2 equals 200. Divided by 1 is still 200. She now has 200 shares sitting in her account.
Her share count just doubled overnight.
But the market price adjusts proportionally in the exact opposite direction to maintain equilibrium.
Right. We take the original $80 price and divide it by the split ratio. 80 divided by 2 is $40.
So now she wakes up, opens her app, and sees she has 200 shares trading at a price of $40 each. 200 times 40 is exactly $8,000.
Exactly. Her total portfolio value is identical. The only thing that fundamentally changed is her cost basis per share. It dropped from $80 a share down to $40 a share.
Okay, that's the easy one. Let's try a harder one, because 2-for-1 is just too simple for the exam writers. They love testing odd ratios to make sure you actually know the formula.
They definitely do.
Let's look at the classic 3-for-2 split. What if Sloan has 200 shares at $60 a share and Frank executes a 3-for-2 split?
We follow the exact same process. Step 1, establish the starting value. 200 shares times $60 a share is a $12,000 total overall value.
Okay, total value locked in at $12,000.
Step 2, calculate the new share count. We take her 200 shares, multiply by the first number of the ratio, which is 3, and divide by the second number, which is 2.
Okay, 200 times 3 is 600. 600 divided by 2 is 300. She now owns 300 shares.
Got it, 300 shares. Now what's the new market price?
Well, step 3, we do the inverse math to the price. We take the $60 original price, divide it by the first number, 3, and multiply by the second number, 2. 60 divided by 3 is 20. 20 times 2 is 40. The new adjusted price is $40 per share.
And step 4, let's verify our math to make sure we didn't create money out of thin air. 300 shares multiplied by the new price of $40 a share is $12,000. The total value is completely, perfectly unchanged.
Perfect execution. That is a standard forward split. You end up with more shares trading at a lower individual price, but the total value remains static. It is a psychological tool used by management to make the stock look more affordable and increase trading volume among smaller retail investors.
Exactly.
Okay, now let's flip the script and look at the dark side of corporate actions, the reverse stock split.
Oh.
Let's imagine Frank's futuristic flamingos literally catch on fire due to a battery defect. The business model collapses. Wall Street loses all faith in Frank. The stock price violently tanks from $80 all the way down to $2 a share.
Disaster.
Frank goes to his office and finds a terrifying certified letter from the stock exchange. What does that letter say?
It's a formal delisting notice. Major national exchanges like the New York Stock Exchange and the NASDAQ have strict minimum listing price requirements to maintain the prestige of the exchange.
Okay, what's the minimum?
Typically, a stock must maintain a minimum bid price of at least $1 per share. If Frank's stock trades below that $1 minimum for an extended period, usually 30 consecutive days, the exchange initiates proceedings to kick them off the board.
Wow. And then what happens?
They get delisted and sent down to the over-the-counter markets, the pink sheets, which is an absolute death sentence for a public company's liquidity and institutional investment.
So Frank is in full panic mode. He's hovering at $2, drifting dangerously close to that $1 cliff. He needs the stock price to magically jump back up to $10 immediately to get the exchange off his back. But he doesn't actually have the time or ability to fix the underlying business.
Right, fixing the business takes years.
So he executes a reverse split, let's say a 1-for-5 reverse split.
A reverse split does the exact opposite of a forward split. It forcibly combines multiple existing shares into fewer mathematically denser shares, which simultaneously drives the individual share price up proportionally.
Let's use a new analogy here. Imagine you have a giant 1-gallon jug of really weak, watery, cheap espresso. It tastes terrible.
Disgusting.
You decide to put it in a pot on the stove and boil it down until the water evaporates, and you are left with just a tiny 2-ounce shot of incredibly dense, pure, highly caffeinated liquid.
Okay, I see where you're going.
You didn't actually buy any new coffee beans. You didn't add value. You just condensed what you already had to make it appear stronger in a smaller package.
That is a brutally accurate analogy for a reverse split.
So let's look at a new investor, Dave.
Yeah.
Dave owns 500 shares of Frank's failing company at $2 a share. Total value, $1,000. Frank executes this 1-for-5 reverse split to save his listing. What happens to Dave's account?
Take Dave's 500 shares, divide by 5. Dave wakes up, checks his app, and sees he now only has 100 shares.
Ouch, he just lost 400 shares overnight. But what happened to the ticker price?
Take the original $2 price, multiply by 5. The new market price is $10 per share.
And let's verify the math one more time. 100 shares times $10 a share is $1,000. The total overall value of Dave's investment is still exactly the same. Dave didn't lose any actual money from the corporate action itself. He just holds fewer mathematically denser shares.
Correct. But here's the massive exam trap call-out regarding reverse splits. The exam writers will try to test your understanding of market psychology by framing a higher post-split price as a positive sign.
Oh, that's tricky.
They might present a scenario like company XYZ's stock price jumped from $2 to $10 overnight due to a corporate action. This indicates, and one of the multiple choice distractors will be strong earnings growth or increased market demand.
That is completely fundamentally false. A reverse split is almost universally a negative signal. It is a desperate panic move. It is putting expensive makeup on a dying pig to avoid getting kicked off the stock exchange. The underlying fundamentals of the company didn't improve one bit. They just manipulated the share math to stay compliant.
Exactly. Institutional investors view reverse splits very negatively because it signals severe underlying financial weakness. Huge red flag.
So we've established that splits both forward and reverse change the share count and the individual price, but never alter the total economic value. Which brings us to the next massive complex topic. Because when Frank splits his stock, it doesn't just affect Sloan and Dave holding the underlying shares.
No, it sends a ripple effect everywhere.
It sends a mathematical shockwave through the entire market ecosystem. Think about all the derivative side bets and pending unexecuted orders sitting out there on the order books.
This is where the internal mechanics of the market get really sophisticated. The market has to maintain perfect mathematical equilibrium. Let's start by looking at options contracts.
Okay, the side bets. Options. Let's set up a scenario. Let's say a month before Frank announced his 2-for-1 forward split, Sloan bought a call option.
Okay.
That contract gives her the right, but not the obligation, to buy 100 shares of Frank's stock at a locked-in strike price of $80. Suddenly, Frank splits the stock. The actual underlying shares are now trading at $40 on the open market.
Right.
If Sloan's option contract stubbornly stays at an $80 strike price, her option is completely unfairly ruined. It's worthless. Why would she ever exercise her right to buy at 80 when the market is trading at 40?
And that would be a systemic failure. The market cannot and will not allow a mandatory corporate action by a company's CEO to arbitrarily destroy the economic value of derivative contracts held by investors. So the options contracts must be mechanically adjusted to reflect the split.
Let me ask a logistical question. Who actually does the adjusting? Is it broker Bob frantically updating his spreadsheets again? Is it Frank the founder?
No. Thankfully for Bob's sanity, it is not him. Exam trap call out. Options adjustments are handled exclusively by the OCC, the Options Clearing Corporation.
The OCC.
They are the central clearinghouse for all listed options in the United States. They act as the ultimate guarantor, the buyer to every seller, and the seller to every buyer. They are the ones who mandate and execute the structural changes to the contracts, not the individual broker-dealers, and not the issuing company.
So what exactly does the OCC do to Sloan's specific call option during that 2-for-1 forward split?
They adjust the terms of the contract proportionally, using the exact same math we used for the underlying stock. Remember the golden rule, standard equity options contracts control exactly 100 shares.
Okay.
So for a 2-for-1 forward split, the OCC will increase the number of contracts Sloan holds and proportionally decrease the strike price of those contracts.
Let's do the math to prove the equilibrium. Before the split, she had one contract with an $80 strike price.
The OCC intervenes and says, Sloan, to make you whole, you now own 2 contracts, and your new strike price is $40.
Let's check the exposure. Before, she controlled one contract of 100 shares, so 100 total shares at an $80 strike. Her total economic exposure was $8,000. Now, post-split, she controls 2 contracts, meaning she has the right to buy 200 total shares at a $40 strike. 200 times 40 is 8,000. The total economic exposure is perfectly preserved.
Exactly. Forward splits are remarkably clean and elegant. You just receive more standard 100-share contracts at a proportionally lower strike price. But reverse splits are where the mechanics get incredibly weird and highly testable.
Ah, yes, the panic move. Let's go back to Frank's failing company and the 1-for-5 reverse split. The stock went from $2 to $10. What does the OCC do to the options contracts here? Because if they try to use the same logic and they try to divide one contract by 5, you can't really trade 1/5 of an options contract on the open market. It breaks the system.
Right. You cannot have 0.2 of a contract. The system isn't built for fractional derivatives. So instead of changing the number of contracts you hold, the OCC changes the deliverable of the existing contract.
The deliverable, define that. Meaning what the contract actually hands over to you if you choose to exercise it.
Exactly. A standard options contract always delivers exactly 100 shares. That's the industry baseline. But after a 1-for-5 reverse split, the OCC will issue a directive that says, okay, you still own exactly 1 contract. The strike price stays exactly the same as it was yesterday. But if you exercise this contract today, it no longer delivers 100 shares. It only delivers 20 shares. Because 100 divided by the split ratio of 5 is 20.
Oh, wow. So the contract itself becomes mutated. It's a Frankenstein contract. It's no longer a standard 100-share unit.
Exactly. It becomes what's known as a non-standard contract.
Yeah.
And because it's non-standard, and the market needs to know that, the OCC assigns it a modified ticker symbol. So if Frank's normal options ticker was FFF, the reverse split adjusted option with the 20-share deliverable might trade under a modified ticker like FF1.
That is a brilliant piece of practical trivia. If you are looking at an options chain and you see a random number jammed into the end of an options ticker, you are looking at a mutated, non-standard contract, almost certainly the resulting scar tissue from a reverse split.
Definitely.
But the key takeaway for the exam, did the total notional value, the underlying economics of the position, change in either the forward or the reverse scenario?
Never. Whether it's a forward split adding contracts or a reverse split altering the deliverables, the OCC ensures the fundamental economics of the position stay exactly the same. The investor is made perfectly whole.
I noticed in the source material there's a quick passing mention of convertible bonds too. Do they adjust when a split happens?
Yes. They follow very similar logic to maintain fairness. If you hold a corporate bond that features a covenant, allowing it to be converted into, say, 50 shares of common stock at a conversion price of $20 a share,
Right.
and a 2-for-1 stock split occurs, the bond's indenture requires the conversion ratio to adjust automatically. It would become convertible into 100 shares at a new conversion price of $10 a share. The total conversion value remains completely unchanged.
The market is a remarkably ruthless but fair machine when it comes to maintaining mathematical equilibrium. Okay, so that covers options, which are handled by the OCC. But what about open orders?
This is another big one.
Let's say Sloan didn't buy a complex derivative. Instead, she just has a standard stock order sitting on the exchange's computerized order book waiting to trigger. Let's say she placed a good till canceled, or GTC, limit order to buy 100 shares of Frank's stock at $50. But before the stock ever drops to 50 to trigger her order, Frank does his 2-for-1 split and the stock artificially drops to $40. If her $50 buy order is still sitting active on the book, it's going to trigger instantly the second the market opens, and she'll wildly overpay for the newly split stock.
Which is exactly why the exchanges, the actual computerized matching engines at the NYSE or NASDAQ, automatically adjust specific open orders for stock splits before the market opens.
The exchanges do this step, not the OCC.
Correct. For a 2-for-1 split, the exchange's algorithm will locate Sloan's GTC limit order to buy 100 shares at $50, and they will auto-adjust it downward to maintain its relative position on the order book. It becomes an order to buy 200 shares at $25.
Wait, hold on. Let me push back. If the stock splits and the price radically changes, why wouldn't the exchange just cancel all the open orders entirely, wipe the slate clean, and force everyone to manually re-enter their orders at the new prices so there's no confusion?
That's a great question regarding market microstructure. The reason they don't cancel everything is to preserve time priority.
Time priority.
In the stock market, if you and I both place an order to buy at $25, whoever placed the order first gets their trade executed first. It's a queue. If the exchange cancels Sloan's order, she would lose her place in line that she might have been holding for weeks. By auto-adjusting the order, the exchange preserves her vital time priority on the book.
That is a phenomenal detail, preserving time priority. Okay, so we know limit orders adjust. What about stop orders?
Stop orders are adjusted using the exact same logic. They're proportionally adjusted downward to reflect the new price levels so they don't get accidentally triggered by the mathematical artificial price drop caused by the split.
Okay, listeners, time for another direct question to test your logic.
Let's hear it.
Limit orders adjust. Stop orders adjust. What about a market order? If Sloan put in a massive market order to buy shares the night before the split, does the exchange adjust it?
Take a second to think.
No, it does not.
This is an incredibly common, high-probability test question. Why doesn't a market order adjust? Because you have to think about the definition of the order.
Right.
A market order has no specified price attached to it whatsoever. A market order simply says to the exchange, buy these shares right now at whatever the current prevailing price happens to be.
So there's nothing to adjust.
Exactly. Because there is no specific price limit written on the ticket to mathematically adjust, the order simply executes at the new post-split market price as soon as the opening bell rings.
So if the exam asks which order types require downward adjustment by the exchange after a forward split, look for the words limit and stop. Market orders are the notable exception. They do not adjust because they don't have a price. All right, take a deep breath. We have survived the mandatory math section. Let's shift gears and move to the RSVP required events. These are classified as voluntary corporate actions.
We call them voluntary because Sloan actually has to make a conscious, proactive decision here. She cannot just sit back and be along for the ride like she was with the stock split. She has to act.
And since we have thoroughly established that Sloan ignores her mail and deletes her emails, this category of actions usually ends very badly for her. Let's look at the first major one, tender offers. What exactly is a tender offer?
A tender offer is a very public, open invitation issued by a prospective buyer, maybe a rival corporate competitor, or maybe a massive private equity firm, to all the current stockholders of a publicly traded corporation. The buyer is loudly broadcasting, we want to buy your shares, and to incentivize you to sell them to us instead of on the open exchange, we will pay you a significant premium over the current market price.
So Frank's stock is currently trading at $40 on the NASDAQ. The giant rival Pelican company issues a formal tender offer saying, attention all Flamingo shareholders, we will pay you $50 for your shares. But we need at least 51% of you to say yes, so we can gain voting control of the company and fire Frank.
Right. It's often the primary weapon used in a hostile takeover attempt. They are bypassing the board of directors and going directly to the shareholders with cash.
Now, exam trap call-out. Because these are high-stakes, highly volatile situations, the SEC has incredibly strict rules on the timeline to prevent buyers from aggressively stampeding retail investors into panic selling. How long must a tender offer legally remain open for consideration?
SEC Rule 14D1 strictly requires a tender offer to remain open for a minimum of 20 business days.
20 business days, not calendar days. The exam will absolutely offer 20 calendar days as a multiple choice distractor to see if you are paying attention to the details. Do not fall for it. It is 20 business days.
And during that 20 business day window, Sloan has to make a calculated decision. Does she tender her shares to the Pelican Company for the guaranteed $50 payout? Or does she hold on to them, believing that Frank can fight off the hostile takeover and that the stock might ultimately go even higher?
Let me throw a hypothetical at you. What if she gets nervous and says yes on day 5? She formally tenders her shares to the Pelican Company, but then, on day 15 of the window, Frank holds a press conference and announces a revolutionary, world-changing new flamingo technology, and the open market stock price violently rockets up to $70. Can she take her shares back from the Pelican Company so she can sell them on the open market for $70?
Yes, she can. Shareholders have the legal right to change their minds and formally withdraw their previously tendered shares at any point prior to the final expiration date of the tender offer.
Okay, so that's a tender offer. Someone external wants to buy your shares. Let's look at the opposite scenario, a rights offering. This is a situation where the company itself wants to sell you more shares.
Exactly.
Yeah.
Let's say Frank needs a massive infusion of cash to actually build that new flamingo technology. He decides he wants to issue 1 million new shares of stock to raise the money. But he has a legal problem. He has to be fair to his current loyal investors. By issuing new shares, he is diluting their ownership percentage. So, to compensate them, he executes a rights offering. He gives his current shareholders the exclusive right to buy these newly issued shares at a steep discount before he offers them to the general public on the open market.
It's exactly like getting a VIP pre-sale code for a massive concert. You get first access and you get a better price, simply because you are already a member of the fan club.
That's a perfect way to visualize it. These rights offerings are typically short-term, remaining open for roughly 30 to 60 days. And when Sloan receives this rights offering packet in the mail, she has 3 distinct choices.
Okay, let's walk through Sloan's menu of choices. Choice 1. She can exercise the rights. She looks at the deal, likes it, sends in the required cash, uses her VIP code, and buys the brand new shares at the discounted price, maintaining her proportional ownership in the company.
Choice 2. Let's say she doesn't actually have the spare cash to buy more stock. However, the rights themselves have intrinsic mathematical value because they offer access to a discount. So she can take those rights and sell them to someone else on the open market.
She sells the VIP code to a scalper, basically. Choice 3, the Sloan special. She completely ignores the mail, she doesn't exercise them, and she doesn't instruct Bob to sell them. The 60 days pass, the expiration date hits at midnight. What happens?
This is a massive exam trap call-out. If rights expire unexercised, they have 0 value. There is no automatic refund, there is no grace period, there is no extension. They literally become worthless, expired pieces of paper.
They evaporate into thin air. Her total portfolio value just took a hit because her existing shares were diluted by the new issuance, and she gained nothing to offset it. And this is exactly why broker Bob gets so stressed out and develops an ulcer.
Oh, totally.
A good broker-dealer will be desperately calling Sloan saying, "Sloan, you have highly valuable rights expiring on Friday. Either wire me the cash to exercise them or give me authorization to sell them for you. Do not let them go to 0.
Is a fiduciary nightmare when retail clients ignore rights offerings. Brokerages expend massive resources trying to track down unresponsive clients during these events.
Okay, now let's tie this entire conversation back to the very beginning of our deep dive, the timeline of settlement.
Full circle.
How does Frank the founder actually logistically know who gets these rights or who gets a standard quarterly cash dividend? Think about it. People are buying and selling his stock millions of times a day on the exchange. The ownership list is constantly churning. How does he know exactly who to mail the VIP code to?
Frank solves this by relying on a mechanism called the record date. When Frank's board of directors announces the rights offering, or when they declare a quarterly dividend, They simultaneously declare a highly specific date. Frank says, whoever is officially documented on my master corporate ledger as a registered owner at the exact close of business on the record date will receive the rights.
Okay. Sounds simple enough. But wait, remember our discussion about T+1 settlement? If Frank declares the record date is, let's say, Wednesday, and I go on my app and buy the stock on Wednesday morning, I won't actually be on the ledger until Thursday.
Exactly. Because your trade takes one full business day to legally settle. So even though you click buy on the record date, your name won't arrive at the transfer agent in time. You would miss the cutoff.
And this mechanical reality creates the absolute necessity for the X-date, the ex-dividend or X-rights date?
Yes. Because of the T+1 settlement lag, the financial exchange is not the company, but the exchanges set the X-date to be exactly one business day before the record date.
Okay, let's map this out incredibly clearly. Listeners, visualize a calendar in your mind. Frank sets the record date for Wednesday. One business day before Wednesday is Tuesday. Tuesday is the X date. What exactly does the prefix X mean in this context?
X is Latin for without. So Tuesday is the exact date the stock begins trading on the open exchange without the mathematical value of the upcoming dividend or the right attached to it.
So let's run the scenarios. If I buy the stock on Monday, do I settle in time?
Let's trace it. You execute the trade on Monday. It settles T+1, which means you legally own it on Tuesday. Therefore, you are firmly on the books when Wednesday's record date cutoff hits. You get the dividend.
What if I hit the buy button on Tuesday, the morning of the X date?
You execute the trade on Tuesday. It settles T+1, which is Wednesday. You are technically settling on the record date, but the cutoff is the final close of business, and the massive overnight batch clearing process means your name won't be finalized on the master list in time. By buying on the X date, you are legally buying the stock ex-dividend without the dividend. You do not get it.
So the golden rule is, to receive the dividend, you must execute your trade before the X date.
Exactly. And because the stock is now trading without that built-in cash value, the actual mathematical price of the stock drops automatically on the exchange by the exact amount of the dividend on the morning of the X date. If a stock is paying a $1 dividend, the stock price will open $1 lower on the X date.
The market really is a beautifully complex, intertwined machine. Every single rule exists to accommodate another rule.
It is a marvel of logistical engineering. Now, there's one more corporate action we need to touch on before we wrap up, and it's a slight curveball for test takers. Stock buybacks.
Oh, right. Let's say Frank's company is incredibly profitable. He has too much cash sitting on his balance sheet, and he thinks his stock is undervalued. So he decides to use the company's cash to buy his own stock back from the open market.
Right. And by buying those shares and essentially retiring them to the corporate treasury, it reduces the total number of shares outstanding in the market. And mathematically, if you generate the exact same amount of corporate earnings, but you divide those earnings among fewer existing shares, your earnings per share, or EPS, goes up. Buybacks are a primary tool to artificially boost EPS and drive the stock price higher.
But I need to issue an exam trap call out right here. We put this topic in the voluntary actions section of our discussion outline. But is a stock buyback actually a voluntary action for the individual shareholder?
No, it is not. And this categorization trips up a lot of people on the SIE. A stock buyback is entirely company initiated. The company simply goes into the open market through a broker and quietly buys shares from whoever happens to be randomly selling that day, just like any other institutional investor would. Sloan doesn't get a formal letter in the mail asking her permission. She doesn't get a proxy ballot. She doesn't get to explicitly choose whether to participate in a buyback.
So it's not a voluntary corporate action from the perspective of the shareholder needing to RSVP or make a decision. It just happens silently in the background of the market.
Exactly. Tender offers and rights offerings are voluntary because they demand a response. Splits are mandatory because they force a mathematical change on your account. Buybacks are simply company-initiated open market operations.
Wow. We have covered an incredible, massive amount of ground today. We have traced the life of a trade from the initial digital handshake all the way through the complex T+1 settlement process. We've navigated the anxiety-inducing proxy voting maze with Broker Bob, and we have mathematically survived both forward and reverse stock splits.
We have. And these are the fundamental concepts that separate the candidates who just try to memorize flashcards from the professionals who actually understand the deep market mechanics.
Let's cement this knowledge right now. Let's do a rapid-fire recap. I want to change the energy here, turn up the pace. Listeners, this is your ultimate cheat sheet. Visualize the exam questions right now as we hit the top 5 critical, highly testable takeaways from this entire deep dive.
I'm ready. Let's hit it.
Point 1, the finish line. What is the new standard settlement timeline for the market?
T+1 for almost everything. Equities, corporate bonds, municipals, options, and treasuries. Cash settlement means same day, T+0. But it is never the automatic default. You must specifically actively request and negotiate it.
Point 2, the name game. What exactly is street name?
Street name means the broker-dealer is the registered owner on the issuing company's master books, but the retail customer is the beneficial owner. The customer retains 100% of the economic rights, the dividends, the voting power, and all the financial risk.
Point 3, proxy voting. Broker Bob is sweating over his unreturned mail. What is the only thing he can vote on?
He can vote on routine matters, which essentially just means the ratification of independent auditors. Remember the memory trick. The letter R. He cannot vote on non-routine matters, which includes electing directors, approving mergers, or executive compensation. If he gets no instructions from the client, he submits a broker non-vote, which counts for quorum attendance, but absolutely not as an actual vote for or against the proposal.
Point 4, the math. Stock splits.
Stock splits never ever change your total overall investment value. Forward splits give you more shares at a proportionally lower price. Reverse splits give you fewer shares at a proportionally higher price and are almost always a desperate panic move to avoid getting delisted from an exchange. The OCC mechanically adjusts all options contracts, and the exchanges auto-adjust limit and stop open orders. Market orders are the exception. They do not adjust.
Point 5, RSVPs, voluntary actions.
Tender offers require a strict minimum of 20 business days to remain open to the public. Rights offerings expire with zero residual value if they are ignored by the investor.
Absolutely nailed it. That right there is 31% of your SIE exam syllabus. Demystified. Thank you to everyone for taking this deep dive with us today. I know we spent an extraordinary amount of time exploring the why T+1 exists to prevent counterparty risk, why street name was invented to solve the paper crisis, why broker non-votes matter to corporate governance.
It's all connected.
It is. But truly understanding that underlying logic is your absolute best defense mechanism when the exam inevitably throws a weird, convoluted, paragraph-long hypothetical scenario at you. If you know the mechanics, you don't have to guess. You can reason your way to the right answer every single time.
I completely agree. And if I can leave you with one final, slightly provocative thought before you go back to your study.
Ooh, let's hear it.
We spent a lot of time today talking about how T+1 settlement mathematically dictates the X date, and how the entire gear system of the market relies on accommodating that one-day lag in ownership transfer. But financial technology is moving incredibly fast. Consider this. What happens to the entire concept of an X date and the whole complex, multi-billion-dollar machinery of record dates and settlement periods if the market eventually moves to blockchain-based instant T+0 settlement as the permanent default?
Oh, wow.
Yeah. If the trade date is the exact moment of the settlement date, the entire foundational rulebook for corporate actions will have to be completely rewritten from scratch.
That is wild to think about. That massive X-ray machine of market diagnostics we just spent an hour talking about, it's eventually going to get completely re-engineered. Something to mull over as you keep studying for the market of today. Keep studying, keep asking why the rules exist, and we'll catch you on the next deep dive.